Last week we had the first quarter GDP print out of the United States, still the largest and probably the most important economy for global growth. So that first quarter economic growth print was a bit weaker than expected, but that was on the back of the last two quarters of 2023 being a lot stronger than expected. And while this year's first quarter had a couple of weak components such as exports and inventory spending down a bit, the consumer was still spending and there was some good investments. So a mixed result, and also other parts of the world we've seen European and UK and some parts of Asia delivering some better economic growth than last year, where a lot of them, like local economies here in New Zealand and Australia, have been a little bit growing very slowly or not growing at all. So some good news around the world as well.
Now, what does this mean for the returns of investors?
Well, the good news for investors is that equity markets year to date in 2024 have continued their very strong run from that last half of 2023. We've seen equity markets in the first quarter deliver a really strong result, a little bit of pullback in April. What the good news there is that we've seen, as well as these famous Magnificent Seven, these large US tech and communications companies, last year the Magnificent Seven did a lot of the heavy lifting for the share market. The likes of Nvidia, Microsoft, Facebook, Amazon, they'd done a lot of the work last year, and this year we've seen a lot of other companies and other industries, smaller companies, also delivering really strong returns for investors, which has been good for that breadth of the market. The main thing we're focusing a lot on is inflation. It is still the key thing for sort of most economies around the world. A lot of the world, including New Zealand, has seen inflation come down from those scary high levels of a year ago, but haven't come down quite enough into that sort of comfortably into that 1 to 3% band for inflation, where if they get to that level, central bankers will feel confident that they can start to cut interest rates and sort of give some of that easing in the cost of borrowing money for mortgage holders, for businesses, and that will be a positive for markets.